Kia ora, I'm Sharon Brett-Kelly. Today on The Detail, the Magnificent Seven, Michael Burry, the Big Short legend, and the AI bubble.
The concern over in Wall Street has been around the sky-high valuations of AI companies.
I think AI is going to play out over years, if not decades, and we're going to see booms and busts. So I think we're in the middle right now of a bubble.
We could be due a stock market crash.
We look at the warnings about overblown share prices, why investors are getting nervous, and fears that we could all be hurt by another global crisis. The Magnificent Seven are, of course, the big tech behemoths: Apple, Microsoft, Google parent Alphabet, Amazon, Nvidia, Meta, and Tesla. There are also the rising stars like Palantir and OpenAI. The bubble? Sharesies co-founder Leighton Roberts explains.
The market now believes there's a chance that we've overpriced or got a little bit too excited about the value that AI is going to bring to some of these companies in the short term, mostly, and some really large bubbles. So I mentioned the housing bubble earlier. 2008 was one. Prior to that, there was the dot-com, which is when people got very excited about the internet for the first time. This right now has been compared a little bit to that hype. And one of the outcomes from those two periods and other bubble periods is that ultimately there are winners and losers. So some of these companies will prove almost certainly to be very valuable companies on the back of the AI they have, and others it might turn out that the hype was not warranted and they couldn't actually turn that into value. But over time, the markets are engineered for growth as a collective. So the market did recover from previous bubbles, and if this is one and it turns out there's a correction, large or small, then over time, people taking a long enough lens, they can expect that as a whole it will recover.
So what does Michael Burry have to do with all of this?
Michael Burry, the investor who became famous for predicting the massive 2008 housing market collapse in the US, appears to have recently placed a big bet against the US stock market. Now, he was featured in Michael Lewis's book, The Big Short, which was made into a movie.
The whole housing market is propped up on these bad loans. They will fail.
The housing market is rock solid.
It's a time bomb.
So Mike Burry, who gets his hair cut at Supercuts and doesn't wear shoes, knows more than Alan Greenspan.
Dr. Mike Burry, yes, he does.
I'm Harry Smith and I run a global equity portfolio at Fisher Funds.
Can you tell me about what happened when this Michael Burry revealed that he was shorting two big AI stocks? Is that the correct way of saying it even?
It is. And when you short something, you are taking a bet that the share price is going to go down. He came out and said he was shorting Nvidia, which is now the largest company in the world. It's the first company to break through $5 trillion in terms of its size. And they essentially make the computer chips that are fueling this AI boom. And then he also shorted Palantir, which is a data analytics company that has a CEO that is makes some rather controversial statements.
Peter Thiel.
Peter Thiel was one of the founders. He's not actually the CEO.
How does that tie in with what Michael Burry did?
He's essentially saying is that he's seeing a lot of hype around some of these companies that benefit from AI, and he's taken a bet that those shares are overvalued because of the hype, not necessarily because of the technology, but the hype that is in the shares, that he thinks they will go down. But he's not the only person that is pointing towards potential overvaluation. The likes of Mark Zuckerberg, the founder and CEO of Meta or Facebook. You've had Jeff Bezos, who's come out and said it as well, and he was the founder of Amazon. You've had Sam Altman, who's one of the key beneficiaries of AI. He runs OpenAI or ChatGPT. And then you've also had the Federal Reserve in the United States cautioning people on the valuation of parts of the US equity market. And then more explicitly, you've had the IMF and the Bank of England saying that, these technology companies are overvalued as well.
The IMF and the Bank of England have joined the chorus of institutions warning we're in an AI bubble that could be set to burst. The managing director of the IMF today said AI valuations were getting close to the level of internet companies just before the dot-com crash. And a new report from the Bank of England Financial Committee said this. Equity market valuations appear stretched, particularly for technology companies focused on artificial intelligence. Basically means tech companies might be overvalued, and that given tech companies make up such a big proportion of the value of the stock market at the moment, we could be due a stock market crash.
Now, if all these influential people and organisations have already put out the warning, why are we taking notice of one man who got it right once before and made a lot of money from his prediction? We're talking about Michael Burry and the global financial crisis. Here's RNZ's business editor Giles Beckford.
He picked the right crisis, the right topic at the right time to give the warnings. When he was saying that the whole American subprime culture and everything that went with, the way US housing was being financed and how debt-ridden it was and how the big banks were playing and they just couldn't see that it was all going to be a house of cards and crumble. He got it right. He made a lot of money out of it in his hedge fund.
No one's paying attention.
The banks got greedy. And we can profit off of their stupidity.
You want to bet against the banks?
I think we're either high or having a stroke. Kind of brilliant.
The reality is that when you come out with a big win like that, then when you stand up again and say things, people listen to you. And this time round, he's also putting money where his mouth is, which is the bets that he's taken that Palantir and Nvidia will go lower, and he's betting that they're on the way down, that there'll be big losses.
Well, this time around, Burry has bought $1.6 billion worth of financial instruments called options that would allow him to profit from a stock market fall, according to a filing made with US regulators.
Is that the thing that has triggered the tumble of these two stocks?
Look, I think the scepticism level about AI and the stratospheric rise of the big seven tech companies, the Magnificent Seven, as they call them, that's been building for quite some time. One of the big financiers, JP Morgan, all saying, this just doesn't look right. We just don't see how these valuations can be sustained. Interesting little things that came out of the quarterly earnings reports that we saw in the past couple of weeks was that Microsoft and Meta in particular, they announced that they were going to be spending more on AI, and by more I mean by tens of billions of dollars, and their share prices fell because people were saying, what are you going to get for the money that you're investing?
Now, because of the soaring prices of AI stocks, Nvidia, the chip maker, is now the world's most valuable company, worth a record $4.75 trillion US dollars, or 8.41 trillion New Zealand. That's with 12 zeros. The trouble is, the companies just aren't making the money, the trillions needed, to build the data centres to keep up with the growth of artificial intelligence. They're the places that all the information is stored, what we call the cloud, and those huge warehouses are full of Nvidia chips. Harry Smith again.
It's massive, right? It's absolutely huge. So at the moment, there is $1 trillion of investment that has been built in data centres. Now, people are expecting over the next 5 years to invest another $3 to $4 trillion. To try and give some perspective around what that dollar amount actually means, it took the US 40 years to build their interstate roading network. In 3 years, they've spent the same amount of money as inflation adjusted on data centres in the United States. So the investment is ginormous. And so really these companies, you have the likes of Microsoft, Meta, Google, Amazon, Oracle, and together those 5 companies alone plan to spend $3 trillion of investment into AI infrastructure over the next 5 years.
Let's look at an example of one of those companies, OpenAI.
So where OpenAI fits in this is that they currently have about $13 billion of revenue expected for this year. They have made commitments on $1.5 trillion of investment that's going to be needed to be built for them. So on that $13 billion of revenue currently, albeit it is growing really quickly, but they are losing money currently at one of the fastest paces ever in Silicon Valley. And the CEO, Sam Altman, was recently asked about this, about how you're going to get from this sort of $13 billion to grow your revenue to a number needed to support these commitments of infrastructure that's going to be built for you. And he got quite testy actually with the podcast host.
You know, how can the company with 13 billion in revenues make 1.4 trillion of spend commitments?
First of all, we're doing well more revenue than that. Second of all, Brad, if you want to sell your shares, I'll find you a buyer. I just enough. Like, you know, people are. I think there's a lot of people who would love to buy OpenAI shares. I don't think you would,
including myself.
And so Sam Altman, I mean, he's one of the ones who's been warning about the bubble. He might not use those words. And yet here he is getting tetchy with an interviewer who's asking him that very question.
Yeah.
Isn't he?
Yeah, I think he's probably getting the question a lot. I would note that even though Sam Altman did caution, his CFO was interviewed by the Wall Street Journal, and she said that she didn't think there was enough exuberance about AI.
That's dangerous, isn't it?
I mean, I don't know. I think it's hard to give you an answer around whether or not there is a bubble at the moment, right? Because there's no firm, like, we are in a bubble. It's just people's expectations, and that's what makes a market. An easy way to explain it would be like, you might go to university, right, and you might pay whatever the university fees are. You think that is a good investment because after university, like let's just say you go to medical school, you pay the medical school fees, and your return after graduating is you become a doctor and you earn a salary. So you consider that investment that you're making in your education to have a good return. So this whole question around AI is one of what is the return on investment? Because we know the investment is huge. We know that the revenue or profits that are currently generated are very small. And so it is trying to find a path to that return. So how quickly can revenue and profits grow from these AI businesses to support the investment that is currently being made? That is the crux of the question around whether or not there is a bubble.
And that's the thing that's making people nervous.
That is, yeah. And it's exactly the same as .com. So in .com, you had these companies that were worth a huge amount of money, like their shares rallied a huge amount, but they had no revenue to speak of. There wasn't actually a way for these companies to monetize what they had created. And actually it took quite a time for these companies like Google or Meta or Netflix to come along and be able to monetize the infrastructure, which is essentially the internet that was built at that time. And so this is the whole thing with AI, the same thing as well. The big question is, where is the monetization to support the investment that has been made?
I think that's one of the base questions that's being asked right through the tech sector in the US is, look, we know NVIDIA's making the chips, so that's a bit like, being the general store during the gold rush. You made money by selling the shovels and the sieves and the flour and the salt. But the companies that are adopting AI, where are the gains in productivity? Where are the boost to earnings? Well, if the earnings aren't going to be there, if it's not going to be, the game changer in the near term at least, then are they going to be buying as much hardware from the likes of NVIDIA? Is the investment that the likes of Apple and Microsoft and Meta are making, are they worth it? And that's where we see then the investor reaction and the share prices.
So how dangerous are things looking at the moment then? I mean, if it goes the way of the .com collapse or the 2008 financial crisis, the rest of us are in trouble, not just the big investors in these shares.
Look, Sharon, I don't know. Right? The simple point was, if I did know, I wouldn't be sitting here talking to you.
You still would, Giles.
Well, I know, but I'd be at home, just counting my money, stashing it into my Bitcoin collection, and just luxuriating. But the reality is, I don't think most people actually know. It depends what side of the spectrum you want to be on. You've got the boroughs who are saying it's all going to end in tears and there's going to be a big clean out. You've got the enthusiastic people saying, no, this is the start of a bright new dawn that will save the world economy and we're all going to be the better for it, even if it's going to take some time for that to occur. I think it will lie somewhere in between. History tells us that when you have surges like this in particular asset classes or particular stocks or commodities, there is a clean out. The pressure gets relieved. You blow off the froth, so to speak. The irrational exuberance, that great phrase used by Alan Greenspan from the Federal Reserve 25 plus years ago, saying,
how do we know when irrational exuberance has unduly escalated asset values, which then become subject to unexpected and prolonged contractions, as they have in Japan over the past decade?
The dot-com bubble was looking like it wasn't good, and then when the market crashed, it says, well, that's the irrational exuberance. As somebody neatly put it to me at the time, I remember interviewing them, and they said, dear boy, you're just blowing the froth off the pint. That's what's happened. As sure as there are green apples, night follows day, there'll be a clean out. We just know there will be.
Yeah, but are you seeing the same kind of behaviour and the same developments as you saw 25 years ago?
Oh, there's the same irrationality that attends all these things. You have the studious people who do their homework, who believe that they've crafted the right product, that they've followed the right strategy, that they're in the right stocks. And who will go with it and will be there for the long term. And they're usually the survivors. I shudder to use the term cockroaches, but they will come through any explosions. There are those who suffer from FOMO, fear of missing out. And as they say, just as you see the bandwagon, coming up to you, and you think you're going to jump on it, well, actually, it's too late because the bandwagon's probably passing you by. These are the ones making the spur of the moment, the irrational decision saying, oh, I can't miss anything, I'll have a slice of that action. They're the ones who will suffer, depending on how rash they are, but they're the ones who are more likely to get burnt. And there are those who just go, well, it looks like a good punt, and let's go for it.
So are we in a bubble or not?
That's a very good question. The first two key points I'd like to make is that we need to separate hype from the technology. The technology is very real, and for most people it might mean, you might engage with Gemini, which is Google's chatbot, or ChatGPT or Perplexity. Those are sort of the consumer applications. But beneath that, if you go to the doctor and all of a sudden the doctor has an assistant that can record the conversation and take notes for the doctor, well, then the doctor can see an extra patient during the day. That is a great thing for society. Further on, we're seeing developments around AI being used in drug development, being able to analyse all the data that needs to go into the creation of new drugs and the trials, and that has been a real beneficiary. JP Morgan has spoken about the use of AI to save costs and help with fraud prevention. And then also, I think further down the track, it's AI that will drive autonomous driving or robotics as well to a greater extent. So the technology is very real and it is very exciting, and it will likely improve productivity and drive economic growth. Now, the hype, if we think about the hype that's in these share prices, first, if we just understand what a share price is, well, a share price is all future earnings of a company brought back into today's dollars divided by the number of shares, right? So when I'm talking about hype, people are basically saying, hey, the earnings of these companies are going to be massive in the future, so we're going to buy the share price. And that's what I think people are starting to create. The bubble talk comes into question, because then a bubble is basically like people saying, no, the expectation of the earnings growth that these companies are going to deliver is too great, and therefore we are in a bubble in this cycle.
What does it all mean for Kiwi investors who might have the smallest slice of Nvidia or one of those other AI shares? Here's Leighton Roberts of Sharesies, an app used by 900,000 investors.
Yeah, so they can choose over 12,000 different investment options on the platform. So a huge number of companies across New Zealand, Australia, and the US, and then other parts in the world as well. And they can just go in and they can select that, and they can invest anything from a cent really into picking one of those shares.
Oh, from a cent?
Yeah, literally from a cent. Most people don't only do a cent, but from a cent.
Because a lot of these AI shares are very, very expensive, aren't they?
Yeah, they have. So the fractionalization has been important for that. That said, people, like the most popular investments on the platform is still like the S&P 500 fund. So that's the biggest 500 in the US and things like that. So as a general rule, people are not buying really large amounts of these. We do have a cohort of investors, tends to be those with much larger portfolios actually, that are sort of making bigger bets.
Okay. So, and would that cohort tend to, rather than being in a passive fund, tend to be more active in buying and selling their shares?
Yeah, so we have some. So some with very large portfolios tend to diversify with some funds, and then on average sort of 4 or 5 companies that they've picked. But then we have a cohort which is made up of about 3,000 customers who are quite active traders on the platform. So they tend to have large balances and they're very active with it. And they tend to be quite specific in what they're choosing at any given time.
So just looking at AI and I guess, the meteoric rise of these shares, the excitement over these companies like Nvidia, what sort of interest have you seen, and has that grown over, the last couple of years?
Yeah, I think the first thing, like companies like Nvidia were already really widely held shares on the platform. So before they were AI companies, they were still very large businesses. So they, of course, benefited hugely from the AI momentum. So we have seen, as the likes of Nvidia, Palantir have become more household names, we've definitely seen more investment into them. But by and large, it is still people choosing an amount, like a small amount of their portfolio or their Kiwi saver to invest in them. But to be honest, most people's exposure in these companies has grown through how present they are in things like managed funds and the index funds. What's happened in the last week?
I mean, the NASDAQ tech index had its worst week in several months. Michael Burry shorted on the shares, and there's been a lot more talk about a potential bubble. So how do investors react to something like that?
Yeah, on our platform, we haven't seen a huge amount of response yet because, as you say, it's been a bit of a rough week, but on the back of months and months now of very strong performance. And, I think the people using our platform do understand that the price to that performance that they're getting is volatility. So the fact that there will be ups and downs and they can experience that. I think the Michael Burry news has sort of been interesting, and even in the time I've been in Sharesies, I think this might be his 6th or 7th time he's made mainstream news for shorting the next big bubble, and for sure he will be right again at some point. But I think the shareholders on Sharesies tend to take a much longer view than that, and one thing's for sure in my mind, in that AI is going to be a very valuable platform into the future, and it may be getting a little bit too much hype now, and possibly the market's got a little bit ahead of itself. But I think fast forward 10 years, 15, 20 years, things like that, it's going to have proven to added a lot of value to businesses.
That's it for today. The Detail is a newsroom production supported by RNZ and New Zealand On Air. This episode was produced by Gwen McClure and engineered by Phil Benj. Thanks to Leighton Roberts, Harry Smith and Giles Beckford. I'm Sharon Brett Kelly. Mā te wā.